So what we get is every time the ISM goes up, Bitcoin goes up. Why? Well, normally they're printing money or creating liquidity, but also because excess earnings, as the business cycle pick up, get recycled into speculative assets. And we see that small caps like Russell 2000 today hit all-time highs. Why? Because the business cycle is growing and we've got liquidity in the system. And it happens also with crypto.
What if Bitcoin's biggest moves have nothing to do with crypto and everything to do with the global economy? Macro investor Raoul says the same business cycle that drives stocks, small caps, and credit markets is driving Bitcoin higher. As liquidity returns and economic activity expands, Powell believes Bitcoin is entering another powerful phase. His message is simple: ignore the noise, buy the dips, stay in the game, and let compounding do the heavy lifting.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I've always used the business cycle as the way of understanding how asset prices move. It's the key driver of all asset prices. It's how the economy moves. It's the ups and downs, the cyclicality. So when we look at the ISM and the business cycle, we have an observable relationship. In fact, it's highly correlated. So what we get is every time the ISM goes up, Bitcoin goes up. Why? Well, normally they're printing money or creating liquidity, but also because excess earnings, as the business cycle pick up, get recycled into speculative assets. And we see that small caps like Russell 2000 today hit all-time highs. Why? Because the business cycle is growing and we've got liquidity in the system. And it happens also with crypto. It's just driven by the same factor you guys have always invested in. If you're investing in small caps, in equities, you're basically doing the same as buying alts in crypto. If you're buying, credit, decent credit, you can use the same cycle for Bitcoin, same as the NASDAQ. They're all roughly the same thing, driven by the same macro factors. Nothing unusual for it, nothing you can't understand. The only thing you can't understand is the volatility, which I try to explain to you. So, small caps versus large caps. That trade is happening as we speak in the equity markets. It's the same trade in crypto. Here's ETH Bitcoin cross. People go out the risk curve as soon as economic activity picks up because it creates more earnings. More earnings gets cycled through into economic activity. In ETH's terms, economic activity lives on ETH. Bitcoin is not an economic productive asset. It's like gold. It just does nothing on purpose. Sorry, I'm just checking if there's any water here. Okay, so now we know what drives it. We kind of know how not to screw it up properly. You've seen what I've done, and I thought I'd done the right thing until I actually did the maths. But there are some simple rules of how actually to do this. And the simple rules are, remember that it's a log regression channel. You think you do, and then when it falls, right, all of the noise about how much crypto's fallen right now, look at it on the chart. It doesn't really matter. You can't see on the chart, but it actually made a new all-time high. It looks weird because of how the lines are. It made an all-time high. It's come back. It's still within. It's just below one standard deviation oversold versus its trend. This is the buy zone. This is probably a mid-cycle correction, something like we saw in 2020. Because the cycle isn't over, because the business cycle is expanding. And the business cycle is expanding means the economy is expanding, which means it can't be, oh, and NASDAQ's at all-time high, small caps are at all-time high, cyclical plays are all taking off. It can't be the point in the cycle where suddenly crypto underperforms. And we've had a bunch of factors. I'm not going to go into those because that's not the purpose of the talk today. But the purpose is every time it comes below the one standard deviation, you should be buying. This is the one trick. The greatest trick I can show you is you buy and never sell until you need to. You want to take some chips off the table. But every time it comes to these levels is when you simply must add. Because if not, you're missing the greatest compounding machine the world has ever seen. Since 2012, Bitcoin is up, even after this correction, is up 23 million%. There is not an asset in history that's done that. Ethereum, in its shorter period, has done even more. Solana, in its shorter period, has done even more. I mean, these things are unbelievable assets, but this is what you've got to remember. Now, that volatility is terrifying, but also on the upside as well as the downside. The upside is FOMO. So here's a tweet that I've been using for a long time. It's my "don't fuck this up" thesis. And it's a simple way to keep you out of trouble, because we all get into trouble in this space. Firstly, don't use leverage. Leverage in a 70% volatility asset is always equal to bankruptcy. You will always get wiped out. It happened in October. I know it's happening because in my head I'm starting to think, maybe I could just be really careful and add another 30% leverage. Well, suddenly I would have lost all of my stake. The game is not to lose control of your tokens, because you want to be in this over time. And this means hold your tokens, don't let anybody have them, and don't do anything stupid. And obviously, the moment you start thinking, I could use a bit of leverage, juice my returns, because my friend is making more money than me, please don't. No FOMO. This is a classic one. We've all done it. I've done it. Your friend, you have a couple of glasses of wine. He's like, oh my God, have you got this coin? It's amazing. I'm up 10x already. And before you start doing it, start bleeding out of your core position into what I know as the wallet of shame, is where you start buying stuff you shouldn't be buying because your friend told you, or it's something going up a lot. And we've seen this repeatedly. Oh my God, it's going up a lot. And it starts sucking in attention and you feel like, I'm going to miss out. Usually by the time you get in is the time to get out. It's only when everything's melting up does that work. But again, try not to do that. Have a thesis. It's much easier. Then concentrate. Don't diversify. Diversification is very difficult in this space. You need real expertise. There's not much diversification. Picking alternative tokens, I'll come on to in a bit, hard to do. So you have a concentrated bet of, let's say, Bitcoin, ETH, Solana, SWI, and I'll come on to why those in a bit, and then do nothing. Self-custody or multi-sig, in Switzerland, there's some good custody options as well, but make sure you don't get scammed out of your coins. Never put your seed phrase anywhere. Just don't do anything stupid. Just lock it away and don't attach it to the internet. Don't let other people take your tokens. If you are going to do the degen trade of buying some of the stupid shit your friends are suggesting, by all means do. You want to learn this space. You want to know how DeFi works. You want to learn exactly how you're going to lose money. Do so, but do it with less than 10% of your money. That allows you to feel like you're participating. You can boast to your friends. You don't have to say that you've only got like 1% in this thing. You can say, yeah, I was in that trade too. And it makes you feel all right. You will notice, like, if I look in my wallet of shame now, every single thing I bought is a zero in that, but I probably put 4% of my assets in it, so it didn't really matter. But that's a one way of saving yourself from yourself, because you're the only person who needs saving, and it's from yourself you need saving. Long time horizon. It's not a 4-year cycle. You should think in those terms. It's like, how do I make an absurd amount of money in one asset class over a period of time? It's just holding on to it and not doing anything. Don't let go of your tokens. Stop trying to be clever. Stop trying to trade it. It doesn't work. You have to be a very, very good trader. But some of the best traders in the world that I know, somebody like Alan Howard, a good friend of mine, says, I don't bloody trade this stuff. It's too difficult. I know if we just hold it, it works. Zoom out, remove the noise. All of the noise you read in newspapers, on Twitter, on everything, it's all noise. Over time, the entire financial system is coming onto this. The entire kind of internet is going to use this as the storage verification truth layer to everything. So just wait, let it happen. Expect 35% pullbacks frequently and 50% at least once a year, twice a year. Now, once a year, once every 2 years. Happens all the time. That's in Bitcoin. Everything else goes further down the risk curve. It's just normal. I mean, that's freaked out. Oh my God, I bought, Ethereum's down 60%. Nobody cares. Are the financial system going to stop building on Ethereum? No. They're telling you, they're in fact screaming at you they're going to do it. But no, you're so convinced that you're never going to make your money back that you're going to sell out and be bitter about the trade. And then you'll look back and Ethereum's at 10,000, 20,000, and you'll feel stupid. It does it to everybody. So don't be harsh on yourself, but that's how it works. And BTFD, buy the fucking dip if you can, because that's how you compound. Adding money into weakness makes money. And over time, this little simple trend, that trend is the market cap of crypto, and it takes you to $100 trillion by that 2033. We're at currently $2.5 trillion. That's going to generate $97 trillion of wealth. That's the game. That's the simple game. That's the game we're all playing. Stay in the trend. Even if I'm wrong by 50%, it's going to generate $47 trillion of wealth. All you have to do to get your share is remain in the game.
According to Raoul, the starting point for understanding crypto is the business cycle. Historically, one of the most reliable indicators of economic activity has been the ISM Manufacturing Index. When the ISM rises, economic activity expands. Businesses earn more money, confidence improves, and liquidity increases throughout the financial system. This excess liquidity doesn't just stay within the economy, it eventually finds its way into financial assets. When economic growth accelerates, investors typically move toward riskier investments. Small-cap stocks outperform large-cap stocks. High-yield credit performs well. Growth stocks surge. Powell argues that crypto follows exactly the same pattern. Bitcoin rises when liquidity expands. Ethereum rises when economic activity accelerates. Altcoins outperform when investors become increasingly willing to take risk. In other words, crypto is not disconnected from traditional markets. It's simply another expression of the same macroeconomic forces. Many investors mistakenly believe crypto operates according to its own unique rules. Powell disagrees. He sees Bitcoin, technology stocks, small-cap equities, and other risk assets as different vehicles responding to the same underlying economic engine. The key driver remains liquidity. When liquidity rises, risk assets rise. When liquidity contracts, risk assets struggle. It's that simple.
So here's my original purchase of Bitcoin. It was at $200 back in 2013. I wrote the first ever macro strategy piece on Bitcoin. I said, I think it's worth $1 million if I look at it stock to flow basis like gold, but let's discount Raoul because he's a moron, and so let's call it $100,000. I said at $200, this is the greatest risk reward in my entire career and the best one will ever be given, which proved out to be true. So this was my thesis. My thesis was I was going to hold on for it for 10 years. If it went to zero, I didn't care. But if it was going to go up to $1 million or $100,000, this would be the most significant bet I'd ever made. So what happened was I felt at first like nothing was happening. It kind of rocketed up to 300 or 400. It came back down. I didn't really follow it. And then it utterly exploded. And I was now feeling like I was George Soros and clearly one of the greatest investors the world had ever seen. And then it fell 84%. And again, I was in it for the long term. I knew it was volatile. I was surprised how fast it went up, and I was surprised how fast it went down. But that wasn't really the issue. The issue is it then exploded higher again. So now we get to 2017, and I'm up 10x from my original bet. Okay, I mean, that's a significant trade. Anybody who's had 10x's, you know, those are your once-in-a-lifetime bets. And at the time, I was going through a divorce, so I had to split up some of my assets. And there was a lot of weird stuff going on about they were forking Bitcoin to a different version of Bitcoin. I'm like, I don't know what to do. So I took profits. So now this, to all of you, will look, Raoul is being a rational investor. Right? That's the rational thing we want to do. We're so used to buying and selling. What was this? That was in the 6 months after I sold. So you can now see why I bought. You now see where I sold, thinking I was a hero. It went up another 10x from where I sold it. I sold it 2,000, and it went up to 20,000. I'm like, oh my God, okay, I'll just be happy with the 10x. And then what happened was, obviously, it fell again. And so now we're over here somewhere. And then it rallied into the pandemic, the whole 2020. And in the middle of 2020 was a 50% crash. You can see it kind of here on the chart. So I got back in. It was down 50% in a day. You know, I'd got in and I was feeling like a hero because I bought it, I'd sold it when it went up. You know, I bought it back down when it fell. And then I never sold again. And I kept hold of it. And the reasons I never sold again is what I realized, I'd sold out at 2,000 and I bought back at that 8,500. 8.5 times higher. I mean, 4.5 times higher than where I'd sold. And I actually destroyed money by doing it. Because that $200,000 I put in back in 2013, if I'd just done nothing, it would have been $100 million. But I didn't. And the lesson you've got to learn here is the hardest lesson for everybody to learn. This is a game of compounding an exponential trend. The volatility is your friend, it doesn't matter. Had I had bought those cyclical sell-offs, I'd have made 25 times as much money as that. That's something, if you just added the same amount, that's something people don't understand. You're so wired to sell the top of the cycle, buy back in, because you're so used to cyclical assets that are not in exponential trends. These ones are in exponential trends. What does that mean? It means they go up in a log regression endlessly. So they look scary when you see charts like that. And you can't even see the moves in the end. And we'll see the log regression channel later. But this is the lesson to learn, is the sell-offs you buy, you compound your wealth. This is why Bezos, this is why Elon Musk, this is why Bill Gates, this is why every rich person to come out of Silicon Valley is as rich as they are. It's because they didn't sell their shares. It's because they held on to them, because they're a network adoption model. Google is a network adoption model. Facebook, a network adoption model. And this is the most powerful one of all time. The greatest performing assets we've ever had. And yet we spend all of our days talking about, are we at the top yet? Oh, it shouldn't matter. Because where's it going? It's going to $1 million. After $1 million, where's it going? I don't know, $5 million. It doesn't really matter. Over time, it'll compound because it's a network that will get used. But that's just Bitcoin. That's only part of the story.
To illustrate this lesson, Pal shares his own experience. In 2013, he bought Bitcoin around $200. At the time, he believed it represented one of the greatest risk-reward opportunities he had ever seen. His thesis was simple: hold it for 10 years. If it went to zero, so be it. If it succeeded, the upside would be enormous. Initially, the strategy worked. Bitcoin rose dramatically, then crashed, then surged again. By 2017, Pal had achieved roughly a 10x return. Feeling responsible and rational, he sold part of his position. From a traditional investing perspective, this appeared sensible. But then Bitcoin increased another tenfold. Suddenly, the decision looked far less intelligent. Eventually, he bought back at much higher prices. And that's when he realized something profound. His attempts to be clever had actually reduced his wealth. Had he simply held his original position, he would have made significantly more money. The lesson transformed his investment philosophy forever.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.